Yeah, they get a sunburn, just like you and me. The UV actually scrambles DNA of bacteria, and so it's not that it kills them, it makes it so that they can't reproduce. So it kind of like you're using UV, just same thing that like people when they go lay down in a tanning bed, if you expose water to that UV irradiation, then it prevents you from getting sick from it.
I took an optics class in electric optics in my bachelor's, and I liked it a lot.
Yeah. Yeah, it's interesting
Crazy
stuff.
way it works.
Okay, so let's see. You've got, you just turned in homework 4, right? And now you've got 2 weeks to the next homework assignment. So the next one's not due until the 28th of February. But before then, there are a few other things that's on your to-do list. We have the exam in class on Thursday. We'll have 75 minutes for that test. I'm going to be writing the exam in the hopes that most of people will finish in about 50 minutes. And so there should be plenty of time. I'm not intending for it to be the sort of thing that you run out of time on. Now, of course, if you don't know the underlying material, then no amount of time is going to feel comfortable for you. And if you haven't gone through the in-class exercises or you haven't done the homework assignments, if you haven't got the reps in, then 75 minutes may not be enough time. But it's not my intention to just give you so many questions that even a strong student is overwhelmed. As I've already mentioned, I'm going to provide you some equations, the equations that you'd use to calculate factors like A/F, F/P, and so on. That list of equations, and then also the tables for a certain interest rate. I'll give you those. But then you can bring a page of whatever you need. And I'm not even implying that you need to bring anything, because if you feel comfortable enough with some of the Excel stuff that we've done, you could show up to the exam with no formula sheet and do just fine. The exam will have some concept short answer type questions, and it'll also have problem solving. The majority of the points are going to be coming from problem solving questions. So now, looking a little bit past that to Thursday the 23rd is when your project will be due. And I've been getting a variety of good questions on that. And I imagine probably after now the homework's submitted and then after the exam is done, probably everyone will be turning more of their attention to the project. But any schedule-related questions, anything about the announcements you want to ask about? Okay. So today we're going to do a relatively straightforward Excel operation to illustrate the idea of unrecovered investment balance, which is related to rate of return, and internal rate of return specifically. We talked about internal rate of return in our last class. We're going to pick up that conversation today. And then at the end, if we still have some time remaining, then I could answer any questions you might have. I don't have anything formal. I don't have a formal exam review plan for you, but if there are things that you'd like to see the illustration or a certain spreadsheet being done another time, then we could go over that till we run out of class time. Okay, so for the unrecovered investment balance, let's say that you wanted to go into the business of a food truck, and you knew that there were going to be some upfront costs that you had to cover in order to get into the business. So just a certain amount of money had to be spent in order to acquire the truck and all the equipment that fills it and your initial supplies. I looked it up, and the average food truck costs about $85,000, and that includes the ovens, the generator, cash register, and everything else. So if you were in the business of selling hot dogs for as much as $8.50 each, like this Disco Dogs operation, you may think, how could you not break even if you're selling hot dogs for $8.50 each? But when you've borrowed money, a big proportion of your incoming revenue is going to go towards debt service. And of course, there's the cost of the supplies. So, the food expense. There's cost of paying the wages of the employees who are there, permits from the city, food handling permits, and also business license. Presumably this vehicle's going to have to be parked somewhere, and they may have to pay rent or a fee for wherever they're locating the food truck. So there's just a lot of costs, and what we need is some sort of an illustration to show us of the upfront investment, how much of that incoming revenue is going towards servicing the debt versus how much of that is actual profit. And an illustration of unrecovered investment balance is going to allow us to do that. And it's going to be able to answer the question of how long it takes to pay off the food truck if you assume a certain number of sales each year. So the key question that we're going to be answering with this spreadsheet process that we'll go through is, at the end of each year, what is the unrecovered investment balance? And this phrase, unrecovered investment balance, has a built-in assumption that in the case of taking out a loan, for example, you're in debt. And so how much of that debt do you still owe to the bank is the interpretation of unrecovered investment balance. But if you were paying for the truck out of your own pocket and you hadn't taken a loan, the other way to think about it is the money that you bought the food truck with, you could have had that somewhere else, making a return. So, even if you're not taking a loan, in the back of your mind, you should be thinking about the opportunity cost and your minimum attractive rate of return. Maybe the minimum attractive rate of return is the value of your second best alternative. You could have had the money that you went and spent on the food truck, you could have had it in a certificate of deposit maybe that's making 5%. So whatever the case may be, you have some minimum attractive rate of return, an interest rate that is taking into account the time value of money. And what you want to know, if it was your money, is how much of your own investment that you expended to buy the truck have you not yet got back through the revenues that are coming in over time. So regardless of whether you were borrowing the $85,000 or whether it was your money originally, we could still create a graph like this. And this is just really kind of a conceptual graph at this point, but we could put some numbers to it. And that's what we're going to do with the in-class exercise today. But before we get into any kind of numbers, I just want to kind of talk through the qualitative description of this. So let's take it as the case that it was your $85,000. That, this is savings that you had and you decided to buy a food truck. So you spent some money, which ordinarily in a usual cash flow diagram, we would represent that as an arrow that's down, right? In a normal cash flow diagram, if you spend money, then the arrow is down. And this arrow is up, but that's because of the name of the diagram is different from just an ordinary cash flow diagram. An ordinary cash flow diagram is just keeping track of inflows and outflows. And so what we saw was $85,000 being expended at time 0, and then hopefully we're going to have this stream of revenue through the future, some number of years, that makes it balance out. But this, the words that are on the vertical axis, unrecovered investment balance, it's a different type of figure than this. This is just saying of what you invested, how much is unrecovered. Unrecovered means you didn't get it back yet. So you spent a certain amount of money, $85,000, and at time 0, all of it is unrecovered because you haven't had any revenues come to you, and so the entirety of your investment balance is unrecovered. So if we were going to start this figure with the illustration of the food truck, then we'd start off at $85,000, but then it's getting higher during the first year. And what we see is that because of interest, it starts off at the $85,000 unrecovered investment balance, but at the end of a 1-year period, it's the original principal, P, times 1 plus I, where I is some interest rate. Some interest rate. In our case, the interest rate that brings balance between the inflows and the outflows is the internal rate of return. And hopefully that's one of the definitions that you remember about IRR. IRR is the interest rate which makes the inflows and the outflows equal over some number of years. So the amount that you have unrecovered is even higher than the original amount, but then it goes down suddenly with revenue minus expense. So revenue is your sales. So, if you sold 10,000 hot dogs and each one of the hot dogs sold for $8.50, then that'd be $85,000 worth of revenue. But that doesn't mean that you're getting $85,000 worth of profits, because you didn't get those hot dogs for free. You had to buy them from a restaurant supply store. You had to pay the fee of your, the wages of your employees, all the other expenses that we talked about, fuel, insurance, and so on. And so the difference between the revenue and your expenses is profit. So R minus E is profit. And it's the profits which justify the original investment. So you'll notice that it's the profit that brings your unrecovered investment balance lower, because you've recovered some of your original balance when you put those profits back into your pocket. So it's the profits that justify the original investment and bring the unrecovered amount lower. So over the course of each year, what happens is you've got some unrecovered investment balance which increases in the amount of the interest associated with that period, and then that year's revenues bring the unrecovered investment balance lower. Then there's accumulation of unrecovered investment balance due to interest expense, followed by a decrease due to profits. And so there's some certain number of years, N, where the profits and the original investment balance out for a given interest rate. So the internal rate of return is that interest rate that we can solve for that brings equilibrium between the inflows and the outflow over the course of the study period. So it's not that the total number of dollars is the same, because remember, present dollars at time 0 are more valuable than future dollars. So it's not that inflow and outflow are equal, it's that the present value of the inflow and the outflow is equal when all of the future amounts have been discounted at the internal rate of return. So this is a different kind of illustration than we've solved for before, but a lot of the calculations are the same. And to kind of illustrate how the pieces fit together, I've got a template file that I've posted on Blackboard. It's an Excel file that if you go to our Blackboard page on for the course, I've posted this Excel file that we're going to open up together, and we're going to try and find out how different interest rates affect the profitability of projects. But let me give you this handout.
Can I ask you a question?
Of course.
How come the money that's being compounded is restarting at the end of every year based on the amount of revenue minus expenses instead of compounded continuously over that period? You see what I'm saying? Shouldn't it be still based off of your original principle instead of?
That's an interesting point. So you're wondering, why is the increase of why is the interest different each year? And that's a thing, that interest is always based on how much is still owed. It's not based, and like in a mortgage, if you ever get a mortgage, they give you these interesting illustrations that show each month how much of your payment goes towards principal and how much of it goes towards interest. And at the beginning of a mortgage, most of your payment is going towards interest, and a very small fraction of it goes towards principal. And towards the end of the loan, the situation is reversed, that more of your money goes towards interest, more goes towards principal. Let me see if I can find an illustration of that.
basically you're saying if you pay ahead, then you're.
Yeah, but it, like now that makes me wonder, so that if this is a fixed loan, your interest amount is usually fixed. Because, at least with the banks, if you have a 30-year mortgage, and you have a fixed rate, so you have a fixed.
The interest rate is fixed, but how much of your payment goes towards interest and how much goes towards principal is changing every month.
Yes, because they want to get all their interest up front.
Yeah.
To make sure that they get all your interest in case you pay it off in 20 years instead of 30.
Yeah. So this is using an illustration of a $200,000 loan. And let's see, this is, if you have a 20%, $250,000 is the home value. So if you have a down payment of $50,000, then you're financing 200,000, 6.67% interest in 30 years. So the interesting thing is that in that first, is this I guess a year, 13,000 would be going towards interest and only 2,000 would go towards principal. And over time, even if the payment's the same every month, like this is showing that the payment is the same, but on a month-by-month basis, the interest amount is decreasing over time, and the amount that goes towards the principal is going up. Now, you never get down to where it's like zero interest, but at the end, let's say towards the very, very end of the loan, you've only got $10,000 left. So when you've only got $10,000 left, you have to pay interest on $10,000. Yeah, like so, that month you're only paying $55 of interest. And so it's very, it takes some getting used to understand how and why that is. Part of the columns that we're going to look at today would allow you to calculate a table like this on your own. But, like why is it that the interest is so high at first? I guess saying that it's because banks are sinister, that's not exactly, there's a calculation, it's a formula, and it's because, at the beginning of the loan, you have to pay interest on the balance, how much you owe them. And so, if it's 6.67%, then the 0.0667 per year is, we've got to divide that by 12 to find the interest rate per period. Let me get my calculator out here. 0.0667 divided by 12, so that's 0.00558333. Okay, so multiply that by 200,000, and the interest is 1,111.67. So that's, that's what that's showing here. So you're paying this percent, 0.667%. Oh, that's per year. This is per month. Okay, so basically 0.5% per month of whatever your balance is at this given time. So, like, you could pay more than this principal, but like this interest and that principal together, let's find out what is the total payment here. 111.67 and 174.91. Okay, so this is like the total loan payment is $12.86.58. So it's just like that's the amount that's required so that you pay off both the interest that you owe each period, but then also the original 200,000. So if we added up all of the numbers in the principal column, it would be 200,000. And so, and then the interest column, that's just related to whatever the percentage is. So in our case, like they're assuming here the loan rate is 6.67% per year, or 0.00558% per period. So
if you added up all the interest would it be the interest rate times the principal? No?
No, because of the way it compounds. Yeah.
Got it.
Yeah, so it's not simple interest, it's compounding interest. So yeah, that's another interesting question is you're like, what is the total number of dollars that they've collected over the entirety of the loan? They may mention that somewhere.
P times 1 plus I to the n, that's how you get that?
Total interest, oh, because it's not.
Oh, here it is. Yeah, your total mortgage payments is $463,000. So, 200 of that is the principal. So you're paying $263,000 in interest.
How would you solve that though? Because like, with just a simple interest, like you say you had $100,000 in an account, like Chase just said, you do the P times 1 plus I to the N, but that's assuming compounding, but where this is going down each year, the interest is gonna be variable. How would you calculate?
The interest amount is variable.
Yeah, so how would you calculate that?
How would you calculate the total cumulative amount of interest?
Yes.
I think you'd have to do it one row at a time. I don't know if there is a formula where you could just calculate it outright. But, I mean, we could definitely do it on a spreadsheet. Yeah.
Sorry if we got too off topic.
No, it's not off topic at all. And I think it kind of sets a good stage for what we're going to calculate today because, like, effectively, we're going to calculate something very similar to this table. Like, we're going to look at how much of the money goes towards one thing, how much of the money goes towards another thing. And here it's called, like, the principal is just repaying the bank what they gave you. The interest is paying the bank for the use of the money. Yeah, so I think you get the idea. It sets the stage for, so do you have the handout? I gave you the handout. If you go to Blackboard, what you'll find is this template file. The Unrecovered Investment Balance template file. And the handout says to start with a cash flow diagram. So sketch it out on the paper, the cash flow diagram, where we've got you received $85,000. So you're actually just doing the normal cash flow diagram, not the unrecovered investment balance diagram here in Part A. So you get $85,000. Then there's going to be a certain A. 1, 2, 3, 4, 5. It's a 5-year loan, so I need to erase this last one, the 6th. And the interest rate is 4%, and we want to find out, like, what is A. So this is our cash flow diagram that it asks that we draw out in Part A. Now it says use the table lookup method to calculate the amount of the annual payment. And I've given you the factor here to a lot of digits so that we can find out exactly what's the annual payment that we ought to have for this scenario. Okay, so the factor is find A given P is 0.224627113. So in other words, A is the original 85,000. And we're going to multiply it by that factor of 0.224627113. Yeah.
It says you receive.
Mm-hmm.
So,
So you're getting the money from the bank,
yeah.
and so you owe the money to the bank. So I guess it depends on the perspective. The bank's perspective is that they're giving the money. Our perspective is that we're receiving the money up front. So that's a good point. Like, if we were going to draw from our perspective, it would be the inverse of that.
That's what I did. So say I did that on like a homework or an exam, I should probably note that it's from my
Yeah.
perspective because then it'd still be correct, right?
Yeah, and I mean, it's assumed, like she's right, that the way I've written the question here, today you receive, I should have written it the other way too. Yeah, so it's better if you had it the reverse of it. But let's say that what we're trying to find here is the magnitude of the annual payment. Okay, so we know from a matter of perspective it maybe is the inverse. But the A, the annual payment that we're going to have to make, what is that? If anybody's got their calculator, can double check.
Let's see.
Okay, so I think it should be, what, $19,093? Okay. So the payment amount is $19,093 and 30 cents if it's at 4%. Okay. So now you're going to be using the template file that's provided, and I've got some formulas that are defined here, but pay special attention to what these different columns are named. And they have, by the way, column numbers as well. I've used those column numbers in these formulas to kind of just give you the idea of what you need to do. This is actually 11. All right. So the first one, the unrecovered investment balance at the beginning of the year. So at the beginning of the first year, by the way, note that this first row doesn't start at 0. It starts at 1. And that's because the first year starts at time 0 and it goes until 1. So here's the first year. And the beginning of the first year is time 0. The end of the first year is at 1. Okay? Here's the second year. The beginning of the second year is at time 1. The end of the first year is at time 2. So here I'm distinguishing between the beginning of the year and the end of the year. And so the beginning of year 1 is time 0. And the unrecovered investment balance is $85,000 at time 0, meaning the beginning of the first year. Now, what we have to do is here in the second column to calculate the interest during the first year. The interest is payable on the beginning of year balance. So what the bank wants is they want 4% of $85,000 for their interest. So if we say, click on the cell location there and multiply it by the beginning of year balance, they want $3,400 for interest because that's the interest, 4% of the balance. And so now remember, what we're trying to put together here is the numbers that mimic the idea of this conceptual figure. Let me just paste it over here so we can keep track of the different parts that we're trying to calculate. So this third column is saying the balance of the loan at the end of the year, just before the payment. So that means the principal plus the interest that's accumulated, but before you've paid them any money, how much do you owe? So you can see down here from the formulas, it's saying that column 3 is column 1 plus column 2. So equals the $85,000 plus the $3,400. And so it's going to be $88,400. But then we pay the bank this $19,093. So the amount that we give to the bank is $19,093 and 30 cents. Okay, so how much of that goes towards the principal? It's not an arbitrary thing. It's the amount that goes towards the principal is the payment amount minus how much of it went towards interest. So we knew the interest amount was based on the rate and the balance of the loan. So like this, we know is on the up and up. There's no funny business going on with the 3,400. And this 19,093, that's just how much is required to pay the loan off after 5 years. So like we have confidence in that. By the way, let me increase the digits here because now I can see the cents. So the amount that goes towards principal is simply the payment amount minus the interest. Do you have a question? Okay, so it's saying column 4 minus column 2. See down here where we've got these conceptual equations?
That makes so much sense.
So that's how much goes towards the principal, and then unrecovered principal balance. 85,000 was the original principal balance, and we're going to subtract it by how much went towards the principal. Okay, so equals 85,000 minus how much of it went towards the principal. Okay, so I'm going to pause here and allow you to work independently and continue to apply these same ideas, but this next step is maybe the hardest. I'll just remind you that the end of the first year is the same thing as the beginning of the second year. That's the same instant in time.
So the end of the first year is the same as the beginning of the second year?
Yep.
I'm highlighting all the interest, and it looks like it's over $10,000 in interest.
For this one?
Mhm.
Yeah. Okay, so, you know, that tricky leap of mental faith, I guess, is that here it says that 1 equals 6 from the previous year. So here it is the 69,307. The end of year balance for the first year is the same as the beginning of year balance for the second year. And then we can, I think, after that, the interest is just dragging it down, the balance of the loan, it's the interest plus the unrecovered. The amount that you give the bank, that should be the same every year. Let's see if it's, yeah, it's fixed. That's not going to be changing at all. How much of it goes towards the principal will be changing because we don't have as much interest that we have to pay. So more of it goes towards principal. If your balance is lower, then how much interest you owe is lower, and therefore the fraction of your payment that's going towards principal is higher. And so the unrecovered principal balance, it just kind of marches downward to the very end. Now, why is it saying -6? Well, maybe I didn't calculate.
Your payment.
Changed.
Oh, okay. 94, 95, there we go. It should be 93 the whole time, right? Let's see, if I've got those two, then it will be fixed there. All right, so 3 cents. That's not so bad. Now, it makes sense that, you know, it's going to be some fraction of a payment, so probably what the bank would do is they'd want their extra 3 cents in the last year. So now we get down to 0. So unrecovered investment balance can either be thought of in terms of a loan that you took out, or if it's your own money, certain of the, if you break the revenue from each year, or I guess the profits each year, into what fraction is covering the original investment and what fraction is your new earnings, this illustration is the same tool that you could use to understand the difference between those. Okay. Any questions about the spreadsheet?